We're celebrating more than 2 million Canadians choosing Fidelity. And to say thank you, we're giving you a chance to win a branded Fidelity hoodie. Enter by visiting fidelity.ca/hoodie-contest. At Fidelity, performance is more than a number. It's progress, confidence, and momentum. So choose performance, choose advice, choose Fidelity. Now, here's today's show.
Hello and welcome to Fidelity Connects. I'm Marilyn Bardaji, District Vice President of Sales. Data is and always has been in Fidelity's DNA. Today we're exploring how Fidelity's decades of fundamental research power a purely quant process and turn information into repeatable alpha. This process is known as fusion alpha. Our next guest says the real excitement is the secret sauce, blending vast fundamental data science, and advanced quant research into a portfolio that's 95% about selection and not about factors. So what does that actually mean for portfolios, for risk, and for how investors can access differentiated alpha today? Joining me now to unpack all this and more is Fidelity CIO of Advanced Strategies and Research, Gil Haddad. Gil, good morning.
Good morning.
Thank you for joining me.
Pleasure being here.
Gil, you work in the QRI, as we call it, Quantitative Research and Investments division. Can you explain what the dual mandate of the QRI research team is and what you do?
Absolutely. So QRI as an organization is Fidelity's Quant Research and Investing, as you pointed out. It's a 6-year-old organization, give or take, that was born on Fidelity's legacy of quant investing throughout the decades, but sort of started initially as a consolidation effort and then grew to have the dual mandate that we had over the last 6 years. The first one is provide timely and actionable insights for Fidelity's fundamental investors across equity, fixed income, high income, strategic advisors. So think about all the fundamental business units of Fidelity. And the second mandate is to provide or create systematic strategies and differentiated strategies and go to market with them to create new revenue streams for the firm. So over the last 6 years, the organization has grown to become 220 quant researchers, give or take, supported by 250 quant developers. We manage about $400 billion of assets, and then they range from single factor indices all the way to the multi-factor quant equities, systematic fixed income, and a few others, and the liquid alts, which is one of the latest additions to the lineup. So that's the QRI organization. I look after a team called Advanced Strategies and Research that has 3 verticals. The first one is quant research, the second one is alternative data and data science, and the third one is Gen AI research. Mm-hmm. Gen AI research spend their time pushing the limits of language models to extract insights from Fidelity-generated content. So think about all the notes that are generated by fundamental analysts. We take those, we put them in the LLMs, and then we try to identify where are we differentiated from sell side. And then as you can imagine, that could be very beneficial. So that's the Gen AI research. The alternative data and data science team is a team that spends a lot of time to procure the latest and the greatest alternative data sets. So think about credit card, email receipts, satellite imagery, and so on and so forth. We ingest those data sets and we provide KPI forecasts to the fundamental teams and to the quant strategies that tell us about how the companies are doing. Mm-hmm. The quant research team is a collection of a dozen or so researchers spending all their time to extract insights from proprietary and differentiated data and then create systematic strategies that we were able to go to market with. So that's sort of the team that we have today.
Would you be able to take a company, for example, or a specific data set that you're working on, give us an example and walk us through those 3 segments? Would you be able to do that?
Great question. So absolutely I can. So let's start. I'm going to take a couple examples for you here. And then so what the process, the flow of the process is. So let's take a retailer, Lululemon, and then let's take a burger restaurant, or maybe a coffee store. Let's start with Lululemon, for example. In Lululemon, if we're looking to understand the top line revenue of the company, that's an easy thing to do. So you can take credit card data, and then you can sort of map and then have daily transactions from credit card, and it tells you what's the top line revenue of Lululemon at the end of the quarter going to be, and then you can forecast that. But what if the driver of Lululemon is not the top line revenue? What if it's the month closing line? And it's an example here. So first, how do you identify that? you have the LLMs, or the team that's working on the LLMs is looking through the analyst notes. The fundamental analysts are talking about what is the driver of the stock. And then so we identify that from the text. And then as you identify that, the model is telling you this is an important driver. Then you have to take the data and then forecast the men's line of Lululemon. How do you do that? So we have the alternative data sets. We have credit card data, we have email receipt, we have geolocation, and a few others. So you have to put all these data sources together for you to get that view. So you count how many people are going inside the store, and then you have an estimate, probabilistic, of how many of them are males, how many are females, that are provided by the vendor. Then you're counting credit card transaction, and then figuring out the individuals, are the user ID, because we cannot see individuals, of course, but the user ID that is probabilistically tagged as a male is buying X amount of dollars at Lululemon, but that doesn't necessarily tell you that they might be buying for a female, for example. So the next step would be you would take email receipt data, and an email receipt would state very clearly what is it that you're buying from Lululemon. And you put these three pieces of information together, then they can sort of tell you what is the men's line at Lululemon going to be, and then if that's a driver, then you can act on that. Now, we take that information and we share it with the fundamental investors, and then they can put it in their portfolios. On the systematic side, that's an input to one of the strategies, the Fusion Alpha that we discussed. So that's an example. Another example would be, like, let's pick a restaurant or a coffee chain. If, for example, there's a promotion at Tim Hortons, and then you are interested in understanding what's the impact of that promotion on the ticket and the traffic at Tim Hortons. How do you do that? You would get data about promotions from Tim Hortons. When did it start? What is it? How are they institutionalizing the promotion? And then you would get the same thing. Traffic inside the store. Are people going more inside the store? And then when they're going, are they spending more or spending less? Because you can imagine, you can buy an item that's promoted and then 3 items that are not. And then you would hope that when a company does promotion, you would hope that they're attracting more traffic inside the store for them to increase traffic and hence increase sales.
Okay, that's very interesting. If we push it a little bit further, advisors might be wondering how does that reflect in our research, right? So who uses that work within Fidelity? Do most portfolio managers use this? Do most analysts use it? Or is it specifically for, and we're going to talk about it, but there's a fund that you manage called the US Advanced Strategies Fund, if I'm correct.
Yeah.
So who uses that information?
All of the above.
Okay.
Really, it's all of the above. So the way it works is we start working with the fundamental analysts. So at Fidelity, we have a centralized equity research department. You have a collection of 120 or so analysts that they're conducting deep research on their own coverage. And then they would ask us, hey, can you tell me about the top line revenue of a particular retailer? So we would go look at the data that we have. We would provide the best forecast we would have out of that data. And then we'll give them to the analyst. Now, the analyst, it's only one piece of their mosaic, because of course they're talking
fundamental.
Exactly.
They meet with the companies.
Exactly. So they take that information and it gives them conviction whether the company is going to meet or miss on that particular line item. And then they publish a note, and then they put it in the system, and the portfolio managers are acting on it. They're either buying or selling that security. But of course, the PMs have a view on the security. And then the PMs consume the same data in a slightly different format. Now, consumption differs between PM to PM, but then generally speaking, is both of them are consuming it. And then Fusion or Advanced US Equities, on the other side, capitalizes on the data from our analysts. So we take the note that they write, and then you break it down into its different elements. It has a rating that's from a strong buy to a strong sell. It has a price target. It has the text that's inside the body of the note. It has a paper portfolio position. All of these are telling you what is the analyst's conviction in that particular security and what's driving it. And then all of that is fed into the systematic process, the Advanced US Equities, and then you're putting a bet on the idiosyncratic risk or that particular idea. So taking a step back, the data, the large investment in data that we made is really consumed by fundamental analysts, fundamental PMs, and the systematic strategies.
So that fundamental research or the analyst notes, you use them as an input for the process that you use? Is that what you're saying?
Exactly. So On our side, Advanced US Equities, the fund that we use capitalizes, or it's intended to capitalize on Fidelity's best ideas coming from the analyst. So we take, if you break down their process, you have an analyst meets with the company management. We know who they met with, when they met with them, and the note that they write after the meeting. Then they go update their Excel model on the company or their financial model. So that information is captured. Then they write a note on the security that has a rating, the paper portfolio, the price target, all of that, and the body of the note. And then they go update their paper portfolio. So Advanced US Equities is trying to capitalize on each and every node of data, and then trying to harness the alpha that's captured or encapsulated in that node of data. And then when you do it in a systematic fashion across the entire universe, it provides you with the ability to create the systematic strategy.
In those databases that you use, I'm guessing you buy them. Is it internal property at Fidelity? Where do you get them from?
So the analyst data is what I think one of the most differentiated fundamental data assets on the street. It is proprietary to Fidelity. We've never given them to anybody. We will never give them to anybody. And then as a result, you end up with this very rich data set or data asset that resides within the four walls of the firm, and then we're able to harness the alpha from that data set. And then the best part, the firm has been consistently storing that data for decades, which is truly remarkable.
So that's for the analyst notes. Obviously, our research is internal. But you mentioned, for example, the Lululemon or the Tim Hortons, right?
Yeah.
So all that data, where do you get it from? Do you purchase it? Do sometimes companies like Lululemon or Tim Hortons, do they give that information? Do they ask? I'm assuming if I'm Lululemon, I would be interested to, the analysis that you generate out of that data that you gather.
So there's a big industry out there around alternative data, and there is data aggregators, data processors, and then data providers. And then those companies, their job is to take exhaust data from different processes and then package it in a way and sell it. Now, Lululemon can go directly to them and buy it, and then we go directly to the data vendors and buy it. So we don't provide Lululemon with that data. So typically corporations go directly to the data vendors, and then as you point out, what they're interested in is competitive dynamics. They want to see, are they doing better than Alo, for example, on a particular clothing line, and you can get that from these data vendors. For us, we consume it directly from the vendor. We buy it, and then we store it in-house, and then we maintain what's called point in time for us to be able to do repeatable research. And then we've been doing that for years. Now, the key there is that the ability to be able to spend on the data and to spend significantly, because these data sets are not cheap. They're very, very expensive. So Fidelity has done an incredible job at actually putting the governance process and being able to have the spend allocation for us to buy great data sets that give us views on fundamentals of companies.
Right. I also read that you're top decile in terms of data accessibility, right? So
we do spend significantly on data in the top decile. I certainly believe so. When it comes only to alternative data, and in the bigger scheme of things, we spend significantly on data as a firm. And then the reason spend is important there is the more you can spend on data, the more differentiated and nuanced are the data sets that you get access to, and then the higher your chances is at alpha. So I'll give you an example from a credit card perspective, which is now a dated data set that's been used for a while. You can buy the data set in a packaged format, which is aggregated at the ticker level, that tells you Lululemon's same-store sales week on week. And then that data set is not very expensive. It's in the six figures. But then from that data set, you cannot get a view for the men's line from Lululemon. So how do you do that? You have to buy the raw panel that has individual transactions at the user level, and then you have to aggregate it yourself and come up with a view that answers the specific questions you're asking. To get access to that data, you automatically jump to the seven figures. So it's an order of magnitude more.
Wow, okay.
And then so being able to spend and then having, of course, the governance body around ingestion and making sure there's no PII, there's no MNPI, and so on and so forth, that effort is significant. And then the firm is really committed and has spent significant resources to allow us to be where we are today.
So for advisors wondering if we might eventually, sell that data or that work that you do, going back to what I said about, let's say, Lululemon or Tim Hortons, if certain companies say, I'm interested in knowing what you derive out of that analysis,
We don't. No, it's all the research that we produce within the firm stays within the firm.
Okay.
And then that's part of our philosophy, our edge, and then of course there's regulatory reasons around it. But all the research that we produce, whether for fundamental and for quant,
for internal purposes.
For internal
strictly.
purpose, the only way to get access to it is through the portfolio. So you get exposure to that data, and that investment we're making is through investing with the portfolios that we have.
More reasons to invest with Fidelity.
Exactly.
So a lot of Canadian advisors know our products, they know our factor-based products, right? How does that compare, or how does that differentiate, for example? So it's a bit of a different market because you're from Boston. I'm assuming there's maybe more competition or maybe more quant-based products in the US, but how does that compare to the factor-driven ETFs, for example, that we offer here to advisors?
So there's a place for all of them, but let's take from a first principle perspective. When you're looking at a factor, you're buying a risk premium. Mm-hmm. So what that's telling, you believe that a certain factor generates return over a certain period of time, or typically a very long horizon, and then this is when you're buying the factors, and then that has a very good place in your portfolio, and it's satisfying a certain exposure that you're looking for, and that's been around for a long time, and it's effective over different horizons. Now, you can put multi-factors together, and this is where we have multi-factor quant equity, which we have a suite of products for that. And then what you're betting there on a collection of factors. Think about value, growth, quality, and momentum you put together, and you were saying that companies that are growing at a certain CAGR with certain quality, certain earnings quality, and that they go up over time, you believe that they're going to do well, and this is what you're betting on. And of course, you have to believe that's a true philosophy, and that's been very well established and documented in research. Now, there's on the other side of the spectrum is, what if you want to bet on anything that's not captured in factors? So stock selection, or what we call idiosyncratic risk. So what you're betting there is all the information that is captured in a piece of data that cannot be described by factors. Meaning, you decompose your signal or your alpha into what can be explained by the risk model, what can be explained by growth, value, quality, and momentum, and then everything that cannot be explained, you call it residual, and then you can make a bet on that. And then that has been around in the industry for some time, and then a lot of money managers, especially around the hedge funds, are really betting on that, because this is something that is hard to get. You cannot describe by a risk model, and it commands a hefty premium to be able to get that.
That's what you do in the US advanced strategy, right?
Exactly. So that advanced US equities, what it's trying to capture is, you take the information from the analyst, and then you're trying to isolate what information cannot be described by a risk factor, and you're putting a bet on that. And then that's the idiosyncratic risk, or the stock selection component of the analyst, and that you're making a bet on.
Is that what you call the alpha fusion? Can you dive into that process or that word? What does that mean?
So fusion alpha is sort of a umbrella term for the signals that are generated by the analyst, the signal that are generated by the best ideas from the portfolio managers, and the best ideas of the alternative data. So we spend a lot of time to extract signals. A signal for us is a mathematical representation of a fundamental thesis. So let's take, for example, price target. We're saying we believe price target is coming from Fidelity's analysis is predictive of future returns. So for the first thing you do, you see how much of that price target across the cross section can be explained by a risk factor. Whatever is not explained by a risk factor, you're saying, if that's predictive of future return, that's telling you Fidelity's fundamental analysts are capturing information under a price target that has stock selection, cannot be described by a factor risk. You're putting it in the model. We do the same thing on the PM best ideas. We do the same thing on the alternative data. And then you end up with a collection of signals across those three sources of information. And then that's what makes it to the alpha model of fusion alpha. So advanced US equities captures only the analyst component. Fusion captures all three components of data assets we have.
Can you dive in a little further into what the signals are? Because hearing you, and I'm assuming some other people might think that you're talking about technical analysis. It is not that, obviously. So what exactly are signals that are relevant to your process?
So, great question. So we have signals that are driven by the numbers, and I'll give a couple examples. Signals that are driven by text, signals that are driven by best ideas, and signals that are driven by alternative data. And then we group them in these families of signals. So let's take signals driven by the numbers. So we take Fidelity's EPS estimates, the earnings estimates, and then we have a buyable universe, and then you're saying across the cross-section, so if you rank the EPS estimates from top to bottom, and then is that predictive of future returns? And then you do the same thing, you see what's explained by risk factors, what cannot be explained, and then you're making a bet on the residual component. So that's an example of signals by the numbers. Another one would be price target that we spoke about. A third one would be their paper portfolio, their top three positions, bottom three positions, or their ratings. Now, none of these are technicals, as you point out. All these signals are fundamental, driven by Fidelity's fundamental analysts, which is really the alpha engine for the entire firm.
Are there more and more hedge funds in the US that use this approach or use those strategies that you use within your team?
That's been championed by hedge funds for the last 15 years, and it's been a very, very successful business for them. So we're not copying them. We're trying to use parts of the playbook that is effective for us, that works for us in the setup that we have that maximizes value for the firm.
Right, because I remember also reading a little bit about the team. I know we've had a quant team for about 10 years, but your team specifically is newer. It's 5 years old, and it's grown quite significantly. So I'm just curious to know, why was that growth so fast? How did it happen so quickly? And how the fund also has grown a lot, so it must be a very successful team and very successful fund as well.
So I sure hope that's the case, but so quant at Fidelity has existed actually for more than 10 years.
Okay.
We've had multiple decades of quant support, but it was mostly in an embedded function. So what that meant is you had a quantitative analyst sitting with a PM and then helping them with their exposure, helping them analyze their factor risk, and so on and so forth. With QRI being the inception of QRI 6 years ago, the firm decided to become very serious in quant and become a serious quant player. And then they've invested very heavily in data, people, and technology. So we were able to attract talent from different places, from some of the top money managers out there. We're able to invest in incredible data sets and then increase our spend significantly for us to be competitive. And we're able to invest heavily in a technology component that allows us to produce repeatable research and allows us to scale for our investors. So that's been a recent phenomenon with the inception of QRI. The team today my team is 5 years old. It's one of the teams within QRI. But of course, as an organization, I think that's a secular trend for the firm, because the firm believes in the value of quant and its additivity for our shareholders.
How do you think it's going to change in the foreseeable future? Do you see the team growing? Do you see the industry changing? I'm just thinking about AI also. I'm sure you use AI in your work. How do you think it's going to affect your work, change it eventually?
Great question. Our industry is ever evolving. It's not the arrow of time goes in one direction, and then so you have to evolve with it. Otherwise, you perish, and then you're left behind. So we have to constantly re-underwrite our processes, our thinking, and then are we doing the right thing for our shareholders? And then so the alternative data was a big investment for us. We're still going to continue it. Now, AI is another big trend. And as a firm, our stance is use it for efficiency gains. Now, the way we use it is upstream in the process. So how do we synthesize a lot of information in a way that is very effective? So we take all the analyst notes and then identify where are you differentiated from sell side. That is something that used to be very, very hard to do a few years ago. And feasible, but it requires a lot of compute, a lot of model, wasn't very effective and accurate. So that's something you're able to do today very effectively. You can do all sorts of signals from the note. Think about sentiment. Of course, sentiment modeling has been around for a long time, but you can do it much more effectively today. You can analyze the sentiment at a very granular level. If an analyst is saying, I'm bullish on the security for the long term, but then I'm very bearish on the coming into the print, that information is incredibly helpful to put in a portfolio and then to score it over different horizons. You can demean the language from a specific analyst. So think about if both you and I are fundamental analysts, and then you happen to be very pragmatic and I happen to be very upbeat in my language. If I write an upbeat note in my language, then it doesn't matter. But then if you write an upbeat note, you demean relative to your own history, and it's saying Marilyn is being very upbeat about its security, and hence this carries more information than myself writing an upbeat note because my entire history happens to be like that. So it allows you to do very, very nuanced things with text and extracting information that was a little bit harder or sometimes much harder to do just a few years ago.
So the portfolio managers and analysts have the option of using the information you generate or not, right? Do you see them using it more and more? Do you see a value add, like the fund that you manage, right? How is that doing in terms of alpha? Is it generating what you've expected it to generate? How is the performance?
So we have a suite of products. So we have the Fusion Alpha that has 3 product expressions, the long only, the market neutral, and the equity extension. And then we have the advanced US equities. And then generally speaking, those are the research-driven components. We're seeing that the market neutral, they're all based on the same alpha model. The market neutral is the one that has done the best over the last year and a half, which is generally speaking the launch of these strategies. And then the long only, the higher the tracking error has done the less well, or the poor, more poorly. And the reason being is the last year and a half we've lived in a market that did not favor stock selection. Its volatility has been very high. Markets are moving on a daily basis. It goes up by 1.5%, the next day down on 1.5%. So when markets are moving in tandem, it's hard to get your risk out of ideas, and then especially on the long only side. On the market neutral side, you benefit from the short side, you benefit from the no concentration, you have 800 to 1,000 names, so that portfolio has done incredibly well. So what gives us confidence is because all of them are driven by the same alpha model, that we expect that over the long term, when a regime that favors stock selection we're back in that regime, then we expect that all of them to do well, as well as the market neutral has been doing.
So what's an ideal market environment for your strategies?
So it depends on which product expression. So if in a market where that favors stock selection, I would say all of them will do really well. And because this is what they're betting on, and they're betting on the stock selection from Fidelity's fundamental investors that have shown and have demonstrated a very long history of producing alpha on those regimes. If a market is going down, then you would expect that the market neutral that's taking a short bet on the market, and not on the market in general, but on securities, will do well because it's designed to capture that phenomena. The same thing for equity extension, because you're taking a levered bet on the long side, and then you have a short exposure on the short side, so you expect it to be hedged to that phenomena. So it really depends on the product expression. But generally speaking, anytime that there is stock selection is important, is a driver, then we should expect that all of them to do reasonably well.
That's so interesting. I could tell that you're so passionate about what you do. I didn't mention it in the intro, but you have a PhD in mechanical engineering.
I do.
How did you get into this field? Because you initially were working on machinery and lifespan of machinery. I got that correctly?
My graduate school was in machine learning.
Okay.
And then predictive models to forecast the life of industrial assets. So it was supported by an industrial company to work on jet engines, and then figure out the airline, the jet engine is how much longer the engine is going to last. And then so I moved to a energy company that was interested to do the same thing on their equipment, oil equipment. Because the value proposition, if you can forecast when a issue is going to happen to the equipment, that's going to save you a lot of money. And then these equipment are super expensive, then the cost of downtime is very high. But the idea is you're taking data from different sensors and then trying to analyze it within the context of the regime that you're operating in, and then trying to provide a forecast of when an event is going to happen. Now, if I give you all that context without telling you what the equipment is, it sounds like a little bit like securities and stocks. And then I was hired by a hedge fund in New York to do something very similar on stocks. And the idea was, how do you take different pieces of information about the companies, about the market, and then that you can infer or have a forecast on the fundamentals of the company that you can make a bet on. So the similarities are run much deeper than one might think. And I fell in love with the industry, and here I am.
I think you don't apply that passion only for equities, if I'm mistaken. Don't you also analyze, you said fixed income and ESG? We do.
So ESG, we support the ESG team with data, but our team supports, on the data science sides, we do fixed income, high income, and we support strategic advisors and the FAMS organization. But generally speaking, all the fundamental investors, we're providing them with data and forecasts and models. The ESG team at Fidelity, we have a pretty well-established ESG team that have their own research. We happen to provide them with just data and then help them on that front, not necessarily with forecasts.
Okay, can you give an example? Because that's trending, right? ESG is trending a little more. How do you, if we all already have an ESG team, what additional data would you provide?
So an example would be if they're interested, for example, in understanding the weather patterns in a specific in continental US. And we have data that tells us what are the storms that are happening across the country, weather forecasts, and then how it's impacting the municipal bonds and the insurance companies. If that's an input that they can use for their ESG rating, we'll help them with providing that data set. And then they can use it in any way they want and then provide the forecast and their process. Another one would be HR data set. So we buy a multiple HR data sets that tell us about companies hiring and firing and then how they're expanding their footprint across different roles and job codes. And the idea there is they can use that data for them to come up with signals that can be used for their specific ratings. And for us, we have that data set. We have the most granular level of the data, and then we're happy to share it with them. We actually do want to share it with them because the more we utilize the data, the better off, or the better the economics is for the firm.
Does it ever happen that a portfolio manager comes to your team and says, "Hey, I'm looking for that very granular piece of information. Would you be able to provide that for me, or run an analysis and come back with your numbers?"
It happens quite a bit. It happens quite a bit now. At the PM level, they're interested more in one click up, I would say. They would say, give me your top 10 best ideas in consumer, and then based on what you're seeing in the alternative data, and then we provide that to them. At the analyst level is when we get questions like you described, which is, give me a specific forecast on that particular company, and tell me, do we have data sets? If not, can you go get the data and provide that forecast? So we do quite a bit, but more on the analyst side on that specific front. And we do quite a bit of that.
That's very interesting. A lot of very interesting things were said today. I see we're at time. I just have maybe one last final thought. If you were about to share to advisors about your experience within the firm and how this specific, QRI team that your specific division that you're working in has grown and where you see it going, do you think that what would you share with advisors?
It's a very exciting time for Fidelity, for the industry, for quant. I think we live in a world that's driven by data, information, and models. And then I'd like to believe we're at the forefront of that. And then as long as we keep going at it, I think we're in for a good run.
That was a very interesting discussion. Thank you, Gil.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.